All right, so today we're going to take a deep dive
Ooh, deep dive.
into the Federal Reserve's recent decision
Yes.
to hold interest rates steady. And we're really dissecting some of the expert commentary and analysis
Right.
from Bloomberg Television's coverage
Yeah.
of both the announcement and Chairman Powell's press conference
Yay.
afterwards.
Right.
So
Let's get into it.
the big news, of course, rates stay put, so that 4.25% to 4.5% range. But
Yeah.
that's just the headlines. The really intriguing stuff is like, how is the Fed communicating its thoughts on inflation
Right, exactly.
and the labor market?
Yeah, I think there's a lot to unpack beneath the surface here. I mean, even in just the statement itself, like they dropped a phrase
Oh, yeah.
that previously indicated that they were seeing progress on inflation.
Yeah.
And that caused quite a stir in the markets.
Well, yeah, it does feel like they're kind of pumping the brakes a little bit.
Yeah,
On this, like, inflation is cooling down narrative. So does this signal like a more hawkish Fed, one that's less likely to cut rates anytime soon?
Right.
Or is this reading too much into like a simple change of phrasing?
Right. Well, and I think hawkish in this context means that they might be more inclined to raise interest rates.
Right, exactly.
To keep inflation under control. And while Powell characterized the change as, I think he called it language cleanup,
Okay.
the markets definitely interpreted it as a potential shift in thinking. And, some economists believe it was a deliberate signal,
Okay.
while others see it as an overreaction,
Right, sure.
so it's kind of all over the place.
It's interesting. This is a stark contrast to last September when, the Fed was slashing rates
Oh.
because of fears of a weakening labor market. And now they're describing the labor market as quote unquote solid.
Right.
So like what's changed in these past few months?
Yeah, it seems like they're a little bit more comfortable with the current unemployment rate, which is at 4.1%.
Okay.
But they are definitely carefully monitoring potential risks, particularly a slowdown in hiring rates.
I see.
But, it's that delicate balancing act for them, right? Because they want to control inflation without hindering job growth, which is a challenge I think a lot of us can relate to in our own lives, right? Just like finding that sweet spot between like managing our expenses
Totally, yeah.
and making sure our income keeps flowing.
Yeah, definitely. But let's not forget, the political pressures that are swirling around the Fed right now. I mean, President Trump has been pretty vocal in his demands for lower interest rates. So how's all this impacting like the Fed's decision making?
Well, I mean, it's definitely an added layer of complexity to the entire thing. But, Powell did skillfully dodge questions about political influence during the press conference.
Yeah.
He really emphasized the Fed's independence.
Yeah, he seemed to navigate that line of questioning quite adeptly.
Yeah.
But it does bring up this like bigger question, right? How can the Fed maintain its credibility and its independence in the face of all this pressure?
That's the million-dollar question, and it's one that's like closely tied to their long-term effectiveness, because their ability to make decisions based solely on economic data, without bowing to political whims, I mean that is really essential for maintaining public trust in the institution.
Right, absolutely.
It's a big deal.
Yeah, no, totally.
People need to trust the Fed.
Okay, so we've talked about political pressure, but there's another major factor looming over the Fed's decisions, and that is, you guessed it, tariffs.
Right, tariffs, yeah.
Yeah, and no one seems to know for sure what their ultimate impact on the economy will be.
Right.
Which makes, planning for the future incredibly difficult.
Yeah, and it's a wild card that has economists actually draw comparisons to the 1930s.
Oh, wow.
When tariffs contributed to a global trade war and a really devastating economic downturn. And, back then, tariffs were intended to protect domestic industries.
Right.
They ended up hurting everyone as global trade ground to a halt and economies just contracted.
Right. That's a pretty sobering parallel.
Yeah.
So how do tariffs actually like work? I mean, I know that they raise prices on imported goods.
Right.
So that's inflationary, right?
Right. Initially.
But I've also heard that they can be deflationary.
Right.
So how does that work?
Yeah, so you're right. They can have both inflationary and deflationary effects.
Okay.
Initially, they push up prices on imported goods, so that does contribute to inflation. However, if those higher prices dampen consumer demand,
Okay.
it could actually lead to a slowdown in economic activity and eventually deflation.
Oh, okay. So it's like this complex equation with all these different moving parts
Absolutely.
that the Fed has to consider
Yes,
as
absolutely.
they chart their course.
Exactly. The Fed is acknowledging that tariffs could significantly alter their economic forecasts and policy decisions.
I see.
But, there's no playbook for this kind of uncertainty.
Yeah, it's like trying to solve a puzzle where the pieces keep changing shape.
Yes, exactly.
Speaking of puzzles, let's talk about the tech sector.
Right.
Because while the Fed grapples with inflation, tariffs, political pressure, Silicon Valley seems to be in a world of its own,
Right.
experiencing this boom, fueled by advancements in artificial intelligence.
Yeah.
It's fascinating. It's like a paradox.
It is. Yeah, it's interesting. Like, while some sectors are bracing for, potential economic headwinds, the tech sector is attracting investment, creating jobs, generating wealth
Right.
at an astonishing rate. And it kind of begs the question, could this tech boom actually provide a buffer against some of the negative impacts that, we've been discussing?
That is an intriguing possibility. I mean, the tech industry has created enormous wealth in recent years.
It has.
Could that wealth trickle down to the rest of the economy and kind of offset potential slowdowns elsewhere?
It's certainly possible. The wealth generated by the tech sector could lead to increased consumer spending,
Right.
which would stimulate other parts of the economy. Additionally, the tech boom is driving innovation and productivity gains that could have long-term positive effects.
So instead of being this separate entity,
Right.
the tech sector could actually play a really crucial role in stabilizing the broader economy.
That's one potential outcome, but I think it's important to avoid oversimplifying things.
Sure.
Because the relationship between the tech sector and the overall economy is complex and multifaceted.
Okay.
While the tech boom offers potential benefits,
Right.
it also presents some challenges.
I'm kind of curious about those challenges. Could you maybe elaborate a little bit on that?
Absolutely. So one concern is that the rapid growth of the tech sector could exacerbate existing economic inequalities.
I see.
If the benefits of the tech boom are not broadly shared,
Right.
it could lead to, social unrest and instability.
So while the tech boom presents all these exciting opportunities,
Right.
we also need to be mindful of its potential downsides as well.
Absolutely. It's essential to ensure that the benefits of technological advancements are distributed equitably.
Okay.
And that we create policies that support inclusive growth.
Right. I think this highlights a key takeaway for our listeners.
Okay.
Even amidst all this uncertainty,
Yeah,
there are opportunities.
totally.
The tech boom is just one example of how innovation and entrepreneurship can drive economic growth
Yeah.
and create these new possibilities.
That's a great point. And it's important to remember that economic downturns are often followed by periods of significant innovation and growth.
Oh, interesting.
Yeah, challenging times can really spark creativity
Right.
and lead to the development of new technologies and industries.
So while we need to be aware of the risks and challenges that we've been talking about,
Right.
we shouldn't lose sight of the potential for positive change.
Exactly. History has shown time and again that resilience, adaptability, and a willingness to embrace new ideas are essential for navigating these periods of economic uncertainty.
I think this leads us to a really important question.
Okay.
What does all of this mean for the average person
Right.
who's just trying to make sense of this complex economic landscape
Yeah.
and plan for their financial future? I mean, we've covered a lot of ground in this deep dive.
I have.
The Fed's decision, the impact of tariffs, the tech boom, this overall economic uncertainty.
Right.
But now let's bring it all home. What does this actually mean for our listeners' personal finances?
Yeah.
Should they be making any changes
Right.
to their financial plans right now?
That's a great question, and one that's, likely on a lot of people's minds right now. I mean, it's easy to feel kind of overwhelmed by
Right.
all the information and conflicting opinions out there.
Yeah, and I think it's natural to want to take some kind of action.
Right.
To feel like you're in control
Right.
when things feel so uncertain.
Totally.
But what's the best course of action? Should people be making these drastic changes to their investments and their
Right.
spending habits right now?
My advice would be to, first of all, just take a deep breath.
Okay.
and resist the urge to make any impulsive decisions.
Hmm.
Panic rarely leads to good financial outcomes.
Right.
So instead, just focus on what you can control.
Okay. That sounds like some really solid advice. But what does that look like in practice?
Right.
Like what concrete steps could people take to feel more financially secure
Sure.
in this kind of environment?
Well, I think a great place to start is by reviewing your budget.
Okay.
Make sure you have a really clear understanding of your income and your expenses.
Right.
And identify areas where you could cut back if needed.
Okay.
This might involve, making some tough choices.
Right.
But it's better to be proactive than reactive.
It's like that saying, prepare for the worst, hope for the best.
Exactly.
No one likes to think about things going wrong.
Right.
But having a plan in place
Yes.
can make a huge difference if they do.
Absolutely. Another key step is to build up your emergency fund.
Right.
Aim to have at least 3 to 6 months of living expenses saved up
Right.
in a readily accessible account.
Yeah, this is that financial cushion we all need, right? In case of unexpected job loss,
Exactly.
medical expenses, whatever.
Exactly.
It could really take the pressure off and allow you to make more rational decisions during tough times.
Totally.
Okay. So now let's talk about investments.
Okay.
Because a lot of people are wondering, what should they be doing with their money right now?
Right.
Given, this current economic climate. Should they be buying stocks, bonds, gold, cryptocurrency? Where should they be putting their money?
Right. I mean, it feels like everyone has a different opinion on what the, smart move is right now.
Totally.
So how can our listeners cut through the noise and make informed investment decisions?
Yeah.
Well,
Unfortunately, there's no magic formula. The best investment strategy for you really depends on your individual risk tolerance.
Right.
Your time horizon, your financial goals. A young person with a long time horizon might be comfortable taking on more risk.
Right.
Whereas someone nearing retirement might prefer a more conservative approach.
So there's no one-size-fits-all answer here.
It sounds like seeking advice from a qualified financial advisor
Sure.
who understands your individual circumstances.
Absolutely.
Could be a good idea.
That's always a smart move, especially if you're feeling overwhelmed or unsure about how to proceed. But, there's a fundamental principle that applies to everyone.
Okay.
And that's diversification is key.
Don't put all your eggs in one basket.
Exactly. Spread your investments across different asset classes like stocks, bonds, real estate
Okay.
to reduce your overall risk. That way, even if one sector takes a hit,
Right.
the others can help to kind of cushion the blow.
It's about spreading the risk and creating a more balanced portfolio.
Exactly. And equally important is remembering that investing is a long game.
Right.
Don't let short-term market fluctuations derail your long-term financial plan.
Okay.
Stick to your strategy, ride out the volatility, and focus on your goals.
Yeah, it's so easy to get caught up in the day-to-day ups and downs
Right.
of the
Yes,
market.
Exactly.
But keeping that long-term perspective is really crucial.
It is.
All right. So we've talked a lot about the potential risks and the challenges
Right.
facing the economy, but how concerned should people actually be
Right.
about a potential recession?
Yeah. Well, while it's important to be aware of the risks,
Okay.
I wouldn't recommend going into, full-on panic mode.
Okay.
Economists are not predicting a recession in the immediate future.
Okay.
The economy's still growing, albeit at a slower pace.
So it's a wait-and-see situation, but what are some signs that things might be headed in that direction? What should people be watching for?
Yeah. I would say keep an eye on key economic indicators, things like consumer confidence,
Okay.
job growth, inflation.
Right.
If those start to trend in the wrong direction,
Okay.
it could signal a potential slowdown.
So stay informed, monitor the situation,
Exactly.
and be prepared to, kind of adjust your financial plans as needed.
Absolutely. And, this brings us back to something we touched on earlier, and that's the potential impact of the tech sector.
Right.
Some experts believe that its rapid growth could actually create a scenario where the Fed's traditional policy tools become less effective.
So the tech sector could throw a wrench into the Fed's plans,
Right.
even if those plans are well-intentioned. It just seems like the economic landscape is becoming increasingly complex and unpredictable.
Yeah, I think that's a really key observation. The tech sector's impact on inflation,
Right.
employment, and consumer spending is not always easy to predict or control.
Mhm.
It's a new variable in the equation, and the Fed is still trying to figure out
Right.
how to adapt.
It's like they're trying to navigate, like, uncharted waters.
Right.
And the map they've been using for decades, like, might not be as reliable as it once was.
Yeah, that's a great analogy.
Right.
And it highlights the need for the Fed to, to be flexible and adaptable in its policymaking. They need to be open to new ideas and willing to, to experiment with new approaches.
So there's a lot of uncertainty.
There it is.
But also a lot of potential for, like, innovation and change.
Absolutely. And that's what makes this such an exciting time to be following the economy. It's dynamic, it's ever evolving, and we're all just kind of learning and adapting together.
Yeah. I think that's a great note to end on. We've covered a lot of ground in this deep dive.
We have.
But it's really just the beginning of the conversation, right?
It is. The key is to stay curious, stay informed, and stay engaged. Don't be afraid to ask questions, challenge assumptions,
right?
Seek out, diverse perspectives.
Absolutely. And remember, knowledge is power.
Yes.
Especially when it comes to, like, navigating these complex and uncertain times.
It is.
Well, hey, until next time, happy diving.
Happy diving.
And don't forget to check out the show notes for links to all the sources we discussed today. 6562.